Worldcom Incorporated executives Scott D. Sullivan and David F. Myers were charged with 7 counts of securities fraud.
Worldcom, a telecom giant destroyed by a massive accounting fraud. At the heart of the fraud, Controller David Myers.
Mr. Myers was a reluctant participant in the events that have led us here today.
What led Myers to participate in the fraud, and where were the auditors who might have prevented it? Find out in this special audit presentation.
Hello, I'm Tom Huff, America's Vice Chair of Assurance Services. As we see in the news, fraud continues to be of serious concern. Madoff, Stanford, and Satyam are 3 recent examples. Many frauds that were hidden in good times come to light in bad times. Once fraud is discovered, the question is always asked, and it's inevitable: where were the auditors? In this video, we'll take a close look at the case of Worldcom, a fraud in which common warning signs and red flags were ignored. Recently, Jeff Hoops, our America's Ethics and Compliance Officer, interviewed David Myers, Worldcom's former controller. Myers now volunteers his time to speak about his role in the fraud. The issues that Myers discusses: pressure to meet earnings targets, control costs, and save jobs, are even greater in this current economic climate. Unfortunately, some companies, perhaps even some of our own clients, may respond to these pressures in unethical and even fraudulent ways. We too are under pressure to control costs and reduce hours, but we must never sacrifice quality for any reason. We must maintain our objectivity and professional skepticism and challenge things that don't look or feel right. No client is worth more than our values and our reputation. We're committed to quality in everything we do and to living our values. Please be assured that you have our full support in always doing the right thing.
Hello, I'm Jeff Hoops, the America's Ethics and Compliance Officer at Ernst & Young. One of the largest accounting frauds in U.S. history occurred at a company called Worldcom. Between 1999 and 2002, Worldcom overstated its pre-tax income by more than $5 billion. The overstatement was caused by fraudulently reducing reserves and capitalizing operating expenses. This Wall Street high flyer ultimately declared bankruptcy. Its stock became worthless and investors lost billions. 17,000 people lost their jobs and their pensions. Worldcom's leaders all went to jail, including the CEO, Bernie Ebbers, the CFO, Scott Sullivan, and the controller, David Myers. Here's an excerpt from my interview in which Myers discusses how CEO Bernie Ebbers influenced Worldcom's culture.
Bernie, when things were good, was your best friend. One of the things that I believe that employees will say about Bernie is that in the cafeteria, he knew most everybody's name in Jackson. He made a point on Friday afternoons of walking through the building, calling people by name, asking them how they were doing. So from an employee's perspective, he literally was a god on earth. Bernie Ebbers' relationship with the board of directors at Worldcom was a good old boys club. The people that were typically on the board were people that he either had brought up from the very beginning, initial investors in the company, or they were either board members or executives of companies that had been acquired. And so each of those individuals, each of the board members actually had a large percentage of their net worth tied into the performance of the company. The board, I don't believe, ever exercised any independence. Literally, the people that were there were Bernie's friends, and I don't believe that in any situation the board ever decided to do something opposite of what Bernie had suggested.
For another perspective on the Worldcom fraud, I also spoke to Dennis Beresford, the former chairman of the Financial Accounting Standards Board. Beresford joined Worldcom's board after the fraud was discovered and led the company's internal investigation of how it had occurred. Beresford and Myers will introduce us to another critical player in the Worldcom fraud, the CFO, Scott Sullivan.
He was acknowledged as CFO of the Year by CFO Magazine, I believe it was. And the directors, for example, considered him to be world class. So there was a certain amount of, that guy just must be a lot smarter than me. And I think that that probably always is a little intimidating to, maybe more than a little intimidating, a lot intimidating to people that work in an organization.
He knew more about the business, the underlying aspects of the business, than any financial person that I ever knew. It was phenomenal working for an individual like that. I mean, literally, he was a steel trap mind. He remembered everything that he had ever seen. He would remember a number to the decimal point, and he could recall that months after the fact.
Myers recalls Sullivan's role at the inception of the fraud.
In the third or fourth quarter of 1999, I personally brought financial statements into Scott and showed him a margin that was, in Scott's words, completely unacceptable. And his exact words were that we had completely, well, these aren't his exact words, that we had screwed up, that we had made a mistake, and to take the financial statements, he wasn't even going to keep them, they were wrong. So, you know, I knew they weren't, but I didn't, you know, at that point in time, didn't know enough facts about it to be able to tell him that he was wrong, so I took the financial statements back. We reworked the entire quarter and came back to the same, basically the same number. So when I took those back to Scott, again, his response was, this is so far off where we had told the public market we're going to be, we can't do this. There must be a mistake. There has to be a mistake. Scott's probably the brightest person I've ever met in my life, from a financial perspective or almost any perspective. And when someone that you respect from an intelligence perspective, I mean, there's obviously a lot of loyalty and everything else. When he says that he knows for a fact that the information that you're providing is wrong, that you've made a mistake, you assume, or I assumed that we had made a mistake. And so we went back and reworked the numbers again, coming back to, for all intents and purposes, the same number. All of this time frame, we're a public company. Public company is about to release its quarterly earnings, and so the time frame to release your earnings is set. The time that we're at this point trying to figure out what's wrong, is we're creeping closer and closer to the time we have to release our earnings. So Scott actually tells me, I know the numbers are wrong, I know what they should be, we need to book an entry to get where I know we should be, and then we'll figure out what the error is at the end of the quarter, and the next quarter is going to be just the same error, but the opposite direction. The two will wipe out each other and everything will be fine, but you need to produce an entry this quarter to fix the problem that I know is there. The entry that was made, quite honestly, was a reduction of expense. What we did was, we had, through acquisitions, we had 200 plus acquisitions. Through all the purchase accounting of all those acquisitions, there were substantial amounts of reserves and things that had gone through goodwill and the like. And so what we ended up doing was reversing out some of those excess liabilities. Did I think it was fraudulent, reducing reserves? No, I didn't think it was fraudulent. The way that I interpreted it, again, through conversations with Scott, is that, first of all, there's an error that we can't identify. So the entry we're making could have been the right entry. We don't know, because all I was told was that there is an error in what we had produced. All of the analytical data from all prior periods pointed to the fact that there was a mistake. So we were fixing a mistake, and so from that perspective, was it aggressive? You could argue that very first quarter, it wasn't even aggressive. It was fixing a problem that you just couldn't quite identify. As an auditor, I had seen my clients who had excess reserves through acquisitions, had reduced those reserves, and they had come up with whatever reasons that they had to reduce reserves to smooth earnings a little bit. It's not something that you wanted to do, but again, it wasn't fraudulent in my mind at that particular point in time.
It's pretty obvious with 20/20 hindsight that the company realized that it had a lot of cookie jar reserves that they had set up in earlier years in connection with acquisitions or otherwise, that they then had the ability to play with. They were reversing accounts without having any basis for making the reversal. but they were probably accrued, the accrual was too high in the first place. Number two, they were not offsetting it against the proper account in the financial statements, and number three, they were not disclosing it properly. And so I just don't agree with the way Myers characterized that.
The expected turnaround in the numbers never happened. The problem was not the accounting, it was Worldcom's weakening business. As Worldcom's reserves dwindled, it became clear that the company would need to do something else if it was to meet earnings targets. Eventually, Scott Sullivan asked the accounting department to capitalize operating expenses.
We got to the end of the year, and the accounting manager that reported to me and I had been talking all this time, and we both knew that while we had at one point in time substantial reserves through acquisitions, we had bled through those very quickly. And the conversation that we had was, we can't keep doing this because there's no more liabilities to release. So we're at the point now where if you release any liabilities, you're actually releasing liabilities to someone that you actually owe. It was the senior manager that reported to me. He says, we can't keep taking items off the right side of the balance sheet. There's nothing there to take off. If you're gonna continue doing what you're doing, you're gonna have to go to the asset side. You're gonna actually have to capitalize something as opposed to expensing it. I don't think at that point in time anybody thought that was a real way to do it, but from a mechanical perspective, that was the next thing to do. Again, I know from my perspective, I didn't think we were going to do that. The senior manager didn't think we were going to do that. He was just saying, mechanically speaking, we can't do this, and if you're going to keep doing something, this is the only way to do it. And in reality, that's exactly what occurred. The rationalization was the fact that we had an underlying cost structure that was based on a network that was built assuming that the .com craze was going to continue forever. So the rationale was not supported by generally accepted accounting principles, but the rationale was that we have underutilized capacity. And so we're going to capitalize that underutilized capacity until we get to the point where we use it. Again, not supported by any accounting doctrine that I'm aware of, but as human beings, if you try hard enough, you can rationalize just about anything.
When Scott Sullivan asked the accounting department to capitalize operating expenses, Myers and his team had to decide if they would participate in what was clearly fraudulent activity. In this segment, Myers explains how Sullivan overcame the accounting department's initial resistance.
Betty Vinson was an accounting manager. She reported to the accounting senior manager who reported to me. Betty was obviously an accountant by trade. She was the breadwinner of her family. She had a teenage daughter, and she was as good an individual as anybody I've ever met, just a good, wholesome accountant, if you want to say. When we had our conversations about capitalizing line cost, Betty was completely horrified. And I can't speak for what was going on in her mind, but I can only tell you that her reaction when Betty is concerned is that she becomes completely quiet. And she also develops a little bit of a rash on her neck. Her neck turns red. And what I noticed. I mean, literally when I told them what them being Betty and Troy Vinson, who was her counterpart, and Buddy Yates, who was the senior manager, what we were being asked to do, Buddy and Troy were very vocal. Betty completely backed up into a shell and was very concerned, obviously. She, after that meeting, came to Buddy and said that she was going to resign. And so the next morning, I came in and Scott called me and asked if it would be all right for him to talk with the individuals, that being Betty, Troy, Buddy, and myself, and try to alleviate some of the pressures that they were under. And he laid a loyalty trip on them that basically said, we need you guys to continue doing what you're doing. it's my responsibility, Scott's responsibility. If anything ever comes of it, it's, I'm the one that asked you to do it. You're only following the directions that I gave you. When we came back the next day, which I think actually it was a Friday, so we came back on a Monday, Betty had indicated that she didn't feel any better about the situation, but she was not going to quit. She would at least stick out a little bit longer, and under Scott's request, and she didn't really know why she was doing that, but right now that was where it was leading her. Troy and Buddy were of the same mindset that we didn't think it was the right way to do it, but it was Scott's decision. He was fully behind it, and he was asking us to do something to help the company. And in our own minds, again, I can't speak for them, I can only speak for myself, there were 100,000 employees that were looking to someone to make sure the company was there. There were investors, everything was in place that if you did something that your mind and your body and is telling you to do, you're blowing it up. And so we said, let's stick with it. Let's see if we can, work our way through this horrible situation. And when we come out the other side, we'll be scarred, but at least the company will be in existence.
Like David Myers, Buddy Yates and Betty Vinson both went to prison for their roles in the fraud. The fraud was eventually uncovered by Worldcom's internal auditor, Cynthia Cooper.
The fraud was ultimately discovered by a very simple internal audit procedure. And it's almost comical if you look at it now. Scott Sullivan asked Cynthia Cooper, who was in charge of the internal audit department, to evaluate the capital expenditures. In his opinion, it was a process that was referred to AFE, approval for expenditure, that for every dollar, basically everything over $1,000 had to be approved by someone. The company was spending literally billions of dollars in its network, and Scott was concerned that things were happening in those expenditures that were not being approved. He couldn't see why we were spending some of the dollars we were spending, and wanted to find where the breakdown in the control was. What Cynthia did was exactly what I would have done. She went out and asked for a complete population of all of the capital expenditures. And then she did what any auditor should do, is she tried to reconcile back the amount of AFEs to what's in the financial statements. Lo and behold, there was a huge discrepancy between what had been capitalized and the sum total of all the AFEs. And so she asked a very simple question. Why is there a difference? I asked Scott, and Scott's response was, well, it's a difference between cash and accrual. I guess that's a good answer. It worked for a couple of months because at that point in time, they just, what we had said was that we were accruing in the financial statements items that had not yet been spent. At the same time, what happened was that the group that reported fixed assets was based in Dallas, Texas. A person that worked in that department had read a story in the Dallas Morning News or whatever the local paper was about a person who had participated in a fraud and had received some civil, criminal, whatever else. There was some problem. That individual got spooked, and so that individual, who I didn't know, called the internal audit department and said, I'd like you to know that this is going on. I'm afraid that if it's uncovered, that that individual will be part of the problem, and I can't do that. So what that individual did was tell Cynthia's department, someone within Cynthia's department, exactly where to go look. Cynthia's group spent probably a month documenting exactly what was going on. What I understand now is that they basically worked their days normally doing what they did, and then at night they worked on this particular fraud to try to figure out where all it was, and because I guess they thought there was a whole lot more to it than it was. It's really one entry a quarter, and they could have been done in 15 minutes, but when you don't know what you're looking for, they kept looking. Well, eventually they had enough evidence to go in and say, tell us what this is, because they found the entries. Cynthia walks in with her lieutenant into my office and shuts the door and puts the entry on my desk and says, We've talked to Betty, Troy, and Buddy. They all say to come talk to you. We'd like for this, find the support for these capitalized entries. And you know, I can remember this like it literally 15 minutes ago, sort of like the entire weight of the world, which you would think would have come down on my shoulders, actually came off my shoulders, because that was the first time I was given the true opportunity to actually say what had happened. And my response was, there is no support. It's something that should not have been done, and there is no generally accepted accounting principles that support what we did.
In the aftermath of the fraud, Myers pleaded guilty and spent a year in prison. Scott Sullivan also pleaded guilty and has just completed a 5-year sentence. Bernie Ebbers was convicted at trial and is spending 25 years in prison. Worldcom's external auditors also suffered severe consequences. The partner and the manager on the engagement were sanctioned by the SEC. Their firm is no longer in business. Why didn't the external auditors discover the fraud? In our final segment, Myers and Beresford discuss some of the mistakes that Worldcom's auditors made and make some suggestions about how auditors can conduct high-quality audits.
The auditors had offices in our building. They were there literally 50 weeks out of the year. And it got to the point where they were, you wonder whether they were employees of the auditors or whether they were employees of WorldCom. You have to understand that this was, by an unimaginable factor, the largest client of this particular, this particular office, and that what they were trying to do was, obviously they were trying to keep their independence, but at the same time, it was imperative that they continue to be the auditors of WorldCom. Almost every employee in that office at some point was on our job, and I think one of the pressures that the auditors found themselves was the same kind of pressures that WorldCom found: growing top line revenue. Now, did they overlook things specifically to keep the job? No, I don't think so. I think they just got overly comfortable, and they accepted the answers because they wanted us to be right. They wanted us to be successful. Some of the answers to some of the questions were not something that you should have just walked away from. I think that if you listen to several of the answers over a period of time, you start connecting the dots, and from a rational perspective, it just didn't make sense.
The auditors were basically inept, in my opinion. They said that they were doing a risk-based audit where they were relying on internal controls. They somehow concluded the internal controls were excellent so they could do limited amounts of testing. As it turned out, the internal controls were awful. When KPMG came in after the fact, they determined that there were numerous material weaknesses in internal controls that had to be remediated. The auditors were not able to have direct access to the general ledger records, which is absolutely unheard of in external auditing.
When I was with Ernst & Young, I was a computer auditor, and so when I would ask that question, the normal response was, well, the audit department, the IT department is extremely busy. We'll do whatever we need to do, but it may take a little bit of time to get the information. What format do you want it in? Those would be standard and expected responses. The responses that the auditors got was, you don't need that. It's a waste of your time, and when we waste your time, you bill us more. So we're not going to provide that level of detail to you. To me, when you ask a question from an auditor's perspective, when you ask a question about, I would like detail behind the general ledger, whatever else, and the answer is anything other than what format do you want it in, I think the flag should go up as to why would you not let us see the general ledger? That's what we're auditing. When you looked at it from quarter to quarter to quarter to quarter, everything looked exactly the way it should. Now, if you take a step backwards and you know what was going on during that point in time, You had AT&T, whose margins were being depressed. You had Sprint's margins that were being depressed. Everyone else was experiencing problems as a result of the dot-com crash and other things that were going on at the time. Why was Worldcom immune to the same things that the entire industry was having problems with? So from an analytics perspective, if all you do is you focus on that one company and you see the trend being exactly what you want it to be, sometimes you ask the question, why is the trend continuing when it doesn't make sense that it should?
Even though the big picture looked pretty good this year compared to last year, it shouldn't have looked nearly so good. So have some general understanding of the big picture for the industry if you possibly can. Having that kind of mindset of not just doing things by rote, but of insisting that you understand why you're doing something will really help you prepare yourself for how it fits into the big picture.
You're auditing not only the balance of that one item that you're talking about, you're auditing the overall income statement, balance sheet, you're auditing the financial statement of the company, not just that one item. So when you get an answer to one thing, you as an auditor know a lot of other things. Piece all of those together, and does it make sense based on what you hear? And if it doesn't make sense, then say, don't follow that. It doesn't make sense. Ask the question another way. Be mindful of the fact that the pressures that are placed on individuals, especially in somewhat troubled times, they will do things that a normal person wouldn't do. When you think that you can do something to help out the company, you'll end up doing things, and as human beings we will rationalize things that shouldn't be rationalized. So you have to understand that in troubling times there will be things that should trouble you. Instead of getting individual pieces of the ledger, ask for the entire ledger. Reconcile back to making sure that everything that you're given reconciles back to the financial statements. I mean, some things that were actually very simple just were not done, and just don't walk through the process just to walk through the process. Realize that your job is you need to understand the company as well as the company does, and your job is to do an audit, and you need to be independent in your thinking.
It's been said that a wise person learns from their own mistakes, but a wiser person learns from the mistakes of others. We hope this program will help you learn from the mistakes of others. Clearly, in these difficult economic times, we're facing pressures from all sides. A much more challenging business environment for our clients. Pressures on us to be more efficient and control cost, and heightened expectations from the regulators and the public. These pressures require us to consistently perform at a very high level. They require sound judgment, including knowing when to consult with others and when to insist that we need more information from our clients. For example, what would have happened had Worldcom's auditor insisted that they be granted access to its journal entry data electronically? Our policies require us to obtain complete electronic journal entry data for all but the smallest, least complex clients. At a minimum, we expect teams to analyze monthly income trends using technology such as that provided in the Global Analytics tool. More is expected of auditors than ever before. We will not compromise our standards for any client for any reason. We believe that striving for excellence in auditing will continue to give us competitive advantage and further differentiate Ernst & Young in the marketplace. It is central to achieving our vision, which includes delivering remarkable client service and high-quality audits. And finally, thank you. Thank you for all that you do for this great firm every day.